Imagine you found out that the bank giving you financial advice was secretly betting against you the entire time. Not metaphorically, literally, documented, prosecuted, and fined nearly $1 billion for it. Now imagine that same bank just published a price forecast for silver, and the market just blew straight through it like it was made of paper, because it was. JP Morgan told the world silver would peak at $81. It is trading at 89 and climbing, and I am not going to let you walk away thinking that was a mistake. What if the forecast was the manipulation? That question is going to sit with you differently by the time this video ends, because I am not here to talk about silver as a trade. I am here to show you a machine, a four-stage machine that has destroyed currencies, transferred trillions in wealth, and repeated itself with clockwork precision across every major monetary collapse in recorded history. A machine that is running right now, and once you see which stage we are in, JP Morgan's forecast will not look like a missed call. It will look like exactly what it was, a last attempt to manage your expectations before the repricing they could not stop finally arrived. Stay locked in. What I am about to show you changes how you read every financial headline from this point forward. And before you think this is just another silver video, another talking head telling you to buy precious metals, I want you to understand something. The people who got destroyed in Weimar Germany in 1923 were not stupid people. They were not uninformed people. They were people who trusted the institutions around them. They were people who did exactly what they were told. They held savings in the currency. They believed the assurances. They accepted the official language as a reliable description of reality. And by November of that year, the savings of an entire generation had been reduced to the value of paper. That is not a metaphor. That is what happens at the end of stage 4. And the only difference between the people who were annihilated and the people who survived was not intelligence, not income, not luck. It was whether they understood the machine before the machine completed its cycle. You are going to understand the machine. Here is a number that most people hear and immediately stop processing. $315 trillion. That is the total global debt inside the financial system right now. The entire planet produces roughly $105 trillion of goods and services per year. Every factory, every hospital, every farm, every software company, every human being working on Earth. Their combined annual output is $105 trillion, and global debt is 3 times that, 3 times the value of everything humanity produces in a single year. In the last decade, central banks created over $25 trillion of new money from nothing. The Federal Reserve's balance sheet went from under $1 trillion in 2008 to nearly $9 trillion at its peak. The Bank of Japan now owns more than half of its own country's bond market. These are not economic policies. These are the footprints of a system running a promise it cannot keep. And here is the critical thing. This has happened before. Every single time, not once, not twice, every time a monetary system has reached this level of overextension, real assets did not just go up. They repriced violently. They transferred enormous wealth from the people who trusted paper to the people who understood the mechanism. You are about to understand the mechanism. It moves in 4 stages. Every monetary system starts with a promise, a gold standard, a convertibility guarantee, a legally binding reserve requirement, a treaty signed by 44 nations. The form changes throughout history. The function never does. The promise creates confidence. Confidence creates participation. And participation builds an entire economic architecture on top of that foundation. This is where the fatal flaw lives, because that promise becomes more expensive to maintain over time, while the temptation to quietly expand the system beyond its limits becomes impossible to resist. That tension is where stage 1 ends and stage 2 begins. The quiet betrayal. The money supply grows faster than the output it represents. Debt expands beyond the system's honest ability to service it. Purchasing power is stolen incrementally, carefully, with language specifically designed to prevent you from recognizing the theft. They call it stimulus. They call it quantitative easing. They call it necessary accommodation. They will call it anything in the world before they call it what it actually is: the organized transfer of wealth from everyone who saves in the currency to the people who control the printing of it. But here is what they cannot control. The betrayal cannot stay quiet forever. The gap between what was promised and what actually exists grows until no language can paper over it. A trigger arrives, a war, a default, a shock, or simply the compounding weight of accumulated imbalances, reaching a breaking point. Confidence fractures. The architects of the system face a single choice: absorb the correction and reset on honest foundations, or print aggressively enough to buy more time. They have chosen to buy time every single time in recorded history, without exception, and that decision is the precise mechanism that makes the 4th stage not just probable, but mathematically locked in. The repricing, the purchasing power that was suppressed, held below the surface by institutional weight, by official language, by price forecasts from banks with very specific reasons to keep expectations anchored, that power does not disappear. It waits. And then it finds expression in the price of real things: gold, silver, land, commodities, the tangible assets that exist completely outside any institution's promise. When the repricing arrives, it is never gradual, never polite. It does not give you a warning. It arrives and it is violent, and it is completely indifferent to the preferences of everyone who bet against it. That is the machine. 4 stages, and I am going to prove it to you 3 times, with 3 separate moments in history that follow this pattern so precisely, it should make your hands shake. Germany, 1919. The Treaty of Versailles hands a defeated, gutted nation a reparations bill of 132 billion gold marks, a figure so large it could not be paid through any legitimate means available to a war-destroyed country. The Weimar Republic establishes the papier mark and promises monetary stability. The promise is thin from day one, but banks lend on it, families save in it, businesses build their futures around it. The architecture of trust is constructed on top of a foundation everyone at the top knows is cracking. Then Germany cannot pay, not through exports, not through production, not through anything real, so it starts printing, slowly at first, then faster. The language stays calm. Temporary measures, manageable adjustments, controlled accommodation. By 1921, the money supply is expanding at a pace that should have triggered alarm in every institution in the country, but the gap between the papier mark's stated value and its real value keeps opening, quietly, almost invisibly, until France and Belgium marched troops into the Ruhr Valley in January 1923. The most productive industrial region in Germany, seized directly because Germany cannot make its payments. The German government responds by calling a general strike across the entire region and paying every single striking worker with freshly printed money. That is the moment the crack becomes a chasm. By mid-1923, hyperinflation is not a warning from economists. It is the texture of daily life. Wheelbarrows of cash for a loaf of bread. Prices updated twice before noon. And then this, the specific number you need to hold in your mind right now. A loaf of bread that cost 200 marks in January 1923 cost 200 billion marks by November. Not 200 million. 200 billion in 10 months. That is years of suppressed debasement closing the gap all at once, in a single catastrophic compression. Stage 4. Anyone holding physical assets, land, gold, silver, foreign currency, anything outside the paper system, survived with their real wealth intact. Anyone who trusted the paper mark, who believed the official assurances, who held savings in the currency, annihilated. The mechanism was not political, not ideological, purely mathematical, exactly as the 4-stage structure predicts. Now let me bring this closer to home. Let me show you the exact night that the system you are living inside right now was deliberately cut loose from reality. August 15th, 1971, a Sunday. Nixon goes on national television and in a single address closes the gold window. No more conversions, no warnings, effective immediately. The promise that had anchored global finance since 1944, the promise that $1 equaled 1/35 of an ounce of gold, the promise that 44 nations had signed their currencies to at Bretton Woods, broken, unilaterally, on a Sunday night, and the world's reserve currency became, from that moment forward, backed by nothing except the government's ability to keep borrowing and the military's ability to enforce dollar demand in oil markets. How did the system get there? The same way it always does: Vietnam, the Great Society programs, the guns and butter economy that forced deficits to grow until the dollars in circulation dramatically exceeded the gold at Fort Knox that was supposed to back them. Charles de Gaulle saw it by 1965, called it an exorbitant privilege. France began demanding gold for its dollar reserves, and the gap between the dollar's promise and its reality became visible from Paris, while Washington maintained the official fiction. By 1971, America held $10 billion in gold and owed over $80 billion in legally convertible claims. The run was beginning. The gap had grown too wide to paper over, and Nixon made the only choice the architects of these systems ever make. Stage 4. Gold moves from $35 to $850 per ounce in under a decade, 24-fold. Silver moves from $1.50 to $49, 33-fold. Not speculation. A mathematical correction, violent and proportional to exactly how long the gap was allowed to grow before it was forced to close. Every person who understood the mechanism was protected. Every person who trusted the official assurances was not. Now, the third case study. And I need you to hear this differently than the first two, because this one did not end. It is still running. 2008, Lehman collapses. The Federal Reserve begins printing. The balance sheet climbs from under 1 trillion to nearly 9 trillion, 3 rounds of quantitative easing, an attempted normalization in 2018 that causes the repo market to seize before the balance sheet makes a meaningful dent, forcing the Fed to abandon unwinding entirely. Then COVID arrives and the printing hits a velocity that makes everything before it look restrained. 40% increase in the M2 money supply in under 2 years, the fastest, most concentrated monetary debasement in the post-war era. And now stage 3 is visible everywhere, if you know where to look. Interest payments on the U.S. national debt have crossed $1 trillion per year, more than the defense budget, more than Medicare, just the cost of servicing what the debasement already created. The fastest rate hiking cycle in modern Fed history produced the fastest regional banking failures since 2008 within 12 months. Commercial real estate vacancy rates above 40% in major markets. Unrealized losses sitting on bank balance sheets that lenders are legally permitted not to disclose at current market value. The system assembled under near-zero rates is structurally incompatible with the rates required to fight the inflation those near-zero rates caused. That is not a policy problem. That is a structural trap with no clean exit. Stage 4 is not approaching. It has already started. Gold is above $3,000, up from $700 in 2008, and silver is at $89, moving through the price ceiling that J.P. Morgan, the largest holder of silver derivatives in the world, told you would hold. Which brings us back to where we started, because now you have the context you did not have at the beginning of this video. J.P. Morgan holds notional silver derivative positions measured in the hundreds of billions of dollars according to regulatory filings with the Office of the Comptroller of the Currency. These are public documents. Look them up. The positions are overwhelmingly short. They profit when silver falls. They absorb losses when silver rises. That bank published a public forecast stating that silver would top out at $81, a forecast that landed conveniently below the level at which their own short exposure becomes dangerous. That is not research. That is a bank trying to use your expectations to manage its own book. And the documented record removes any ambiguity about what this institution is capable of. In 2020, J.P. Morgan paid nearly $1 billion in criminal penalties after federal prosecutors established that its precious metals trading desk had engaged in years of systematic manipulation. Traders criminally convicted of spoofing, placing massive fake orders to move prices, then canceling them before execution. The Department of Justice called it a racketeering enterprise, not a rogue trader, an enterprise, operating inside the world's most systemically important bank. That is not allegation. That is settled federal prosecution. So when J.P. Morgan publishes a silver price target, you are not reading neutral analysis. You are reading a document from an institution with a criminal conviction for precious metals manipulation, a massive short position in the same market, and a clear financial motive to keep your expectations anchored below the level at which their exposure breaks. Now look at the gold-to-silver ratio. Across 5 centuries of monetary history, gold and silver have traded at roughly 15-to-1, reflecting their geological occurrence ratio in the Earth's crust. Right now, with gold above 3,000 and silver at 89, that ratio is approximately 34-to-1, more than double the historical average. Simple mean reversion, with gold not moving a single dollar, would put silver at $200 per ounce. That is arithmetic, applied to a relationship that has survived the Roman Empire, the British Empire, the gold standard, and every monetary transition in between. And then there is the industrial layer sitting underneath all of this. Solar panels require silver paste as an electrical conductor. There is no commercially scalable substitute. Solar capacity must more than triple by 2030 to meet projected targets, and every gigawatt requires 50 to 60 tons of silver. Electric vehicles, 5G infrastructure, medical devices, all consuming silver at rates that have expanded since 2020 and have not contracted. Silver is the most monetarily underpriced asset on the planet and the most industrially essential material for the technologies defining the next 30 years. The monetary story does not need the industrial story. The industrial story does not need the monetary story. Both are true simultaneously. That structural convergence is what J.P. Morgan's forecast was trying to keep you from understanding. So here is what you do with this. But first, let me deal with the 3 objections you are going to hear, because someone in your life is going to push back on this, and I want you to be ready. The first objection is American exceptionalism. The dollar is the reserve currency. It cannot follow the same path as the papier mark or the pound. But the United States is running a $2 trillion annual deficit on top of $36 trillion in accumulated federal debt, with interest payments that have already crossed $1 trillion per year and are still climbing as older low-rate debt matures and gets refinanced at current rates. Reserve currency status has bought time. It has never bought immunity. And the longer it buys time, the wider the gap that must eventually close. The math does not negotiate with national identity. The second objection is central bank sophistication. Modern monetary theory, forward guidance, macroprudential tools. The system is too advanced to collapse the way simpler systems did, but the Federal Reserve tried to normalize its balance sheet after 2017 and was stopped by a repo market seizure before it had made a meaningful dent. It raised rates to fight inflation in 2022 and produced the fastest banking sector stress since 2008 within 12 months. Sophistication here means increasingly complex interventions to manage the increasingly severe consequences of previous interventions. That is not a solution. That is a treadmill that only runs in one direction. The third objection is technology. AI, productivity gains, the next industrial revolution, growth will outrun the debt. But the United States currently spends approximately $4 trillion per year in federal outlays and collects approximately $3 trillion in revenue. No productivity wave in economic history has closed a structural fiscal gap of that size while simultaneously carrying the debt service cost that gap has already accumulated. Technology is real. The structural math is also real. And the math does not pause for the technology to catch up. The pattern does not bend for exceptionalism. It does not slow for optimism. It does not negotiate with complexity. Every single time it has reached this stage, it has completed, without exception. You have a savings account, a retirement fund, a 401k, or some combination of paper assets that you were told, by institutions with documented incentives to keep you in paper, is safe, responsible, and prudent. That advice was defensible in Stage 2, when the debasement was incremental and the gap had not yet reached its current width. It is not defensible in Stage 3, where the gap stops being managed and starts being expressed, always at the expense of paper, always in favor of real. This is not a call to panic. Panic is what people without a framework do when Stage 4 arrives and they have no way to understand what they are watching. This is not a call to chase recklessly either. The most violent repricing in precious metals history comes in compressed windows that reward people who positioned before the headlines confirmed it, not after. This is a call to recognize which stage you are in, to understand the machine, to stop letting the institutions that built the system that is now fracturing anchor your expectations at the level that protects their exposure rather than your savings. The window is still open. Think about what it would have meant to hold this framework the week before Nixon closed the gold window in August 1971. The people who understood the mechanism in that moment did not need to predict the specific trigger or the specific date. They just needed to understand which stage they were in. Then Nixon went on television on a Sunday night and the window got dramatically narrower. Fast. The trigger for Stage 4's most violent expression in the current cycle has not arrived yet, but the structural conditions that produce that trigger have never in history been more fully formed than they are right now. The next video goes deeper into the machine, how the suppression system was built, who built it, what the regulatory record shows about how it has operated across decades, and what history tells us about how suppression systems at this scale terminate, because they always terminate. And when they do, the repricing does not take years, it takes weeks. Subscribe, turn on notifications, because Stage 4 does not wait for you to feel ready, and the math is already speaking. The only question left is whether you are listening.